The Fed's impact on crypto, boom or bust for Bitcoin. The Federal Reserve's influence on the cryptocurrency market, particularly Bitcoin, is a subject of significant interest and debate. In this video, we'll explore how the Federal Reserve's policies and announcements can affect the value and perception of Bitcoin. Monetary policy and fiat currency value. The Federal Reserve plays a pivotal role in shaping the value of fiat currencies, such as the US dollar, through its monetary policy decisions. When the Fed adjusts interest rates, lowering them to stimulate borrowing and spending or raising them to curb inflation, it directly influences the supply of money in circulation. Additionally, measures like quantitative easing, where the central bank buys government securities to inject liquidity into the economy, also impact the money supply. These actions can have profound effects on investor confidence in traditional currencies, as they signal the Fed's stance on economic stability and inflation management. Investors closely monitor the Federal Reserve's monetary policy announcements and actions, as they can impact the purchasing power of fiat currencies over time. In periods of loose monetary policy, characterized by low interest rates and increased money supply, investors may become wary of the potential for currency devaluation and inflationary pressures. As a result, they may seek alternative assets that offer a store of value and protection against these risks. Bitcoin, with its finite supply and decentralized nature, has emerged as one such alternative asset that investors perceive as a hedge against inflation and currency devaluation. The perception of Bitcoin as a hedge against inflation and currency devaluation stems from its unique characteristics, including its fixed supply cap of 21 million coins and its decentralized network. Unlike fiat currencies, which can be subject to manipulation by central banks and governments, Bitcoin operates on a predetermined issuance schedule, with new coins being generated through a process called mining. This scarcity and resistance to central control make Bitcoin an attractive asset during times of economic uncertainty and potential currency debasement. Regulatory actions and market sentiment. Regulatory actions and statements from the Federal Reserve hold considerable sway over market sentiment towards cryptocurrencies, particularly Bitcoin. The Fed's pronouncements regarding potential regulations or crackdowns on crypto-related activities can trigger significant volatility in Bitcoin prices and the broader cryptocurrency market. Investors and traders closely scrutinize these regulatory developments, as they can signal shifts in the legal landscape and the level of acceptance of cryptocurrencies within mainstream financial systems. Any hint of increased regulatory scrutiny or restrictive measures can prompt sell-offs as investors react to perceived risks and uncertainties surrounding the future of cryptocurrency usage and investment. The impact of regulatory announcements from the Federal Reserve extends beyond immediate price fluctuations, influencing the long-term perception of cryptocurrencies as legitimate investment assets. Positive regulatory signals, such as discussions of clear frameworks and investor protections, can bolster confidence in the market and attract institutional investors seeking regulatory clarity. Conversely, negative statements or regulatory crackdowns may deter mainstream adoption and investment, leading to prolonged periods of price volatility and uncertainty. Therefore, the Federal Reserve's stance on cryptocurrency regulation plays a crucial role in shaping investor sentiment and market dynamics, impacting both short-term trading decisions and long-term investment strategies. In addition to influencing market sentiment, regulatory actions from the Federal Reserve can directly impact the operational landscape for cryptocurrency businesses and service providers. Heightened regulatory scrutiny may result in increased compliance costs, stricter reporting requirements, and potential limitations on certain crypto-related activities. These regulatory burdens can affect the profitability and viability of businesses operating within the cryptocurrency ecosystem, leading to shifts in market dynamics and consolidation within the industry. Moreover, regulatory clarity or ambiguity can determine the level of institutional involvement and investor confidence in the long-term prospects of cryptocurrencies as an asset class. Impact on investor behavior. The actions of the Federal Reserve wield considerable influence over investor behavior in the cryptocurrency market, particularly during periods of economic uncertainty or inflationary pressures. When traditional financial markets face instability or economic downturns, investors often seek alternative assets that offer stability and store of value characteristics. Bitcoin, with its decentralized nature and limited supply, has emerged as a popular choice for investors looking to hedge against the erosion of traditional fiat currencies' purchasing power. Consequently, during times of economic turbulence, we often observe increased demand for Bitcoin as investors flock to this digital asset in search of refuge from the uncertainties plaguing traditional financial systems. Conversely, regulatory uncertainty or negative statements from the Federal Reserve can evoke cautious sentiments among cryptocurrency investors, leading to temporary sell-offs or hesitancy in the market. The Federal Reserve's indications of potential regulatory crackdowns or ambiguous statements regarding the legality and future of cryptocurrencies can inject uncertainty into the market, prompting some investors to adopt a wait-and-see approach. Concerns about regulatory compliance, investor protection, and the potential for increased scrutiny may deter market participants from making significant investment decisions, leading to short-term fluctuations in Bitcoin prices and trading volumes. Overall, the Federal Reserve's actions and announcements have the power to sway investor sentiment and behavior in the cryptocurrency market, influencing the flow of capital and trading activity. While economic uncertainties may drive investors towards Bitcoin as a perceived safe haven asset, regulatory uncertainties and negative signals from the Federal Reserve can induce hesitancy and volatility in the market. Understanding the interplay between Federal Reserve actions, economic conditions, and regulatory developments is crucial for investors navigating the complexities of the cryptocurrency landscape and making informed investment decisions amidst evolving market dynamics. Potential benefits of regulation. Proponents of increased regulatory clarity contend that clear and well-defined regulations could have a positive impact on Bitcoin and the broader cryptocurrency market in the long term. Clear regulations provide legitimacy to the cryptocurrency market, instilling confidence among investors and institutions hesitant to engage with assets in a regulatory gray area. With regulatory uncertainty often cited as a barrier to mainstream adoption, clear guidelines from regulatory bodies like the Federal Reserve could pave the way for broader acceptance of cryptocurrencies as legitimate investment assets. Moreover, transparent regulatory frameworks have the potential to attract institutional investors who have thus far remained cautious about entering the cryptocurrency space due to regulatory concerns. Institutional investors typically adhere to strict compliance standards and risk management protocols, necessitating clear regulatory guidance to mitigate legal and reputational risks. With regulatory certainty, institutional investors may feel more comfortable allocating capital to cryptocurrencies, contributing to increased liquidity, stability, and market maturation over time. Concerns over regulatory overreach. However, there are concerns that excessive regulation could stifle innovation and hinder the growth of the crypto market. Overly stringent regulations may impose burdensome compliance requirements on businesses and restrict access to decentralized finance (DeFi) platforms. Additionally, regulatory uncertainty could drive innovation and users towards more decentralized and anonymous cryptocurrencies. The relationship between the Federal Reserve and Bitcoin remains complex and multifaceted. While the Fed's actions can impact the short-term volatility of Bitcoin prices, the long-term implications are subject to ongoing debate. As the crypto market continues to evolve, the role of regulatory policies in shaping the future of Bitcoin will remain a crucial aspect to monitor. At last, don't forget to subscribe our channel.